How do growers, warehouses, and other market participants efficiently allocate a crop produced one time per year, but consumed and utilized throughout the entire year? Market participants use calendar spreads in the grain and oilseed futures markets to discover prices and manage their risk associated with growing and storing grains. Let's look at the corn futures contract to show you how calendar spreads encourage storage when supplies are plentiful and encourage the movement of supplies to the commercial users that value them the most when supplies are tight. Corn futures expire in the months of September, December, March, May, and July. A market participant holding a long December corn futures contract until delivery would receive a delivery certificate representing 5,000 bushels of corn. Therefore, the price at any given time for a December futures contract represents the expected price in December. For a March futures contract, it will be the expected price in March. And for a May futures contract, it will be the expected price in May. A calendar spread is buying a futures contract that expires in 1 month, while simultaneously selling a futures contract for the same commodity that expires in a different contract month. The price of a calendar spread is the price difference at a given point in time between the two futures contract expiration months. For example, the December-March calendar spread would be the difference in price between the December futures contract and the March futures contract. How are these price differences discovered? Let's assume you manage a grain warehouse. It costs you money to store grain in your warehouse. You incur equipment and labor costs to elevate the grain into your warehouse. You pay the insurance company to guard against fire and flood, and you pay the chemical company for an insecticide to keep bugs out. Each day, you have to make a decision about every ton of grain in your warehouse. Do I sell that ton of grain today in the cash market, or do I continue to store it until tomorrow? Because it costs money to store grain in your warehouse. The only way you would make the decision to store is if you expected to receive a higher price in the future to compensate you for these costs. And if you think about it, that's what futures spreads represent. The December futures price represents prices expected in December. The March futures price represents prices expected in March. Thus, the spread between December futures and March futures represents what the market is offering to store grain from December to March. Around harvest, when supplies of grain are plentiful, the spreads become wider, which encourages storage. Warehouse managers continually adjust their inventory based on signals received in the spread market. If the spreads are too narrow and the market isn't paying enough to store the grain, in other words, the cost of storage is higher than the deferred futures price. Warehouse managers start selling grain today, which depresses the nearby futures price. Less inventory will be available in the future, so the deferred futures price rises. This will continue until the buyer in the market get exactly the amount of grain that they want today, and the rest of the grain is stored for tomorrow. Late in the crop year, when supplies of grain become short, the spreads narrow to discourage storage. For example, if the spreads are too wide and supplies are short, users of grain bid up the nearby price, which narrows the spread and encourages the selling of grain out of storage. In extreme cases, the supplies of grain can get so short that the futures price invert, meaning that the nearby price is greater than the deferred price. In this case, the market is not paying anything to the warehouse manager to store. In fact, it's charging the warehouse to store. When this happens, no warehouse wants to store. But users of the grain, be it millers or exporters or feeders, don't want to be forced to shut down their businesses because they run out of grain. They're willing to store grain at a loss to avoid running out and having to close down their business. In review, in addition to providing producers and users with price discovery and risk management tools, grain and oilseed futures provide those that store grain the correct market signals to assure that a commodity that is produced once per year is efficiently allocated throughout an entire calendar year. Because of this, consumers can count on their favorite products being available regardless of the time of year.